Welcome to the Deep Dive. We're the show that cuts through the noise, digs into the sources, and pulls out the insights that matter for you. Today, we are taking a close look, a real deep dive, into a giant of the financial world, Charles Schwab Corporation, ticker symbol SCHW. And this one's really tailored for you, the American investor. Maybe you're new to this, maybe you've been investing for years. Our job is to pull out the key takeaways. Can this titan, the one built on making investing accessible, can it really keep thriving with all the tech changes and economic shifts? Let's unpack it.
Exactly. And Charles Schwab, it's a major multinational financial services company, definitely one of the biggest in the U.S. when you look at assets. Think of them as kind of a full-service financial partner. They do banking, commercial banking, investments, consulting, asset management, basically the whole suite for individuals and institutions. And their main business areas, well, you've got investor services, that's the retail side. Most people know brokerage, banking, retirement help for individuals. Then there's advisor services, which is huge. That's where they provide custody, trading, all that back office stuff for independent registered investment advisors, RIAs. And of course, asset management itself, holding assets, financial advice, and, a full bank.
And the scale you mentioned, it's just immense. It started way back 1971 as First Commander Corp.
Yeah.
Became Charles Schwab & Co. a couple years later, now headquartered down in Westlake, Texas. But, they're everywhere. Over 380 branches. It's not just a company. It feels like a whole financial ecosystem.
That's a perfect way to put it. And the numbers from the end of 2024 really drive that home. We're talking $10.10 trillion in client assets. Trillion. And think about the reach. 36.5 million active brokerage accounts, 5.4 million workplace retirement accounts, 2 million bank accounts. Their total assets hit $480 billion. And about 32,100 employees making it all happen. These aren't just stats. They show how deeply woven Schwab is into people's financial lives.
Okay, so they're massive, dominant. But for investors listening, it always comes back to performance, right? How are they actually doing lately? What's the financial health look like?
Right, that's the core question. And honestly, their recent Q2 2025 earnings reported July 18th were really quite strong, definitely got the market's attention. Revenue came in at $5.851 billion. That actually beat the consensus estimate, which is around $5.74 billion. Importantly, that's up 25% year over year. Pretty healthy growth.
25%, wow. And what about the bottom line, the earnings per share?
Yeah, adjusted EPS, earnings per share, hit $1.14. That also beat expectations, and it's a jump of 56% from the $0.73 they reported the year before. Really impressive increase there. And digging a bit deeper, the growth drivers look solid too. Total client assets, a record high. $10.76 trillion, up 14% year over year. They pulled in $80.3 billion in core net new assets. That's up 31%, so money is flowing in. And they added 1.1 million new brokerage accounts, up 11%.
So more clients, more assets, more activity.
Exactly. Daily average trades were very strong, 7.6 million. That's up 38% year over year. Shows clients are definitely engaged. Looking back a bit for the full year 2024, revenue was $19.6 billion, up about 4%, net income $5.94 billion. And the trailing 12 months, or TTM, as of March 31st, 2025, showed revenue climbing even more to $20.465 billion. That's almost an 11% jump year over year.
Okay, so the growth looks good. What about profitability? You mentioned some metrics earlier.
Yes, let's look at those TTM numbers as of July 2025. The gross margin is, well, frankly astonishing at 97.19%.
97%. How is that even possible?
It really speaks to their business model. Heavily digital, highly scalable. Once the platform's built, servicing the next dollar of revenue costs very little. It makes them incredibly efficient. Their net margin is also strong at 33.68%. And return on equity, the ROE, which measures how well they use shareholder money to make profits, is a solid 15.91%. Return on assets, ROA, is 1.72%.
Those margins, especially the gross margin, really stand out. For an investor, what does that signal about Schwab's business?
It signals a very healthy, very well-managed operation. They aren't just growing, they're doing it incredibly efficiently, controlling costs tightly. A huge chunk of their revenue drops straight to the bottom line. That efficiency underpins their consistent profitability.
Okay, big, profitable, efficient. So how do they actually make their money? Let's break down those revenue streams.
Yeah, understanding where the money comes from is crucial, especially with interest rates being what they are. So in Q2 2025, the biggest piece by far was net interest revenue. That was $2.822 billion, and that's way up from $2.158 billion the year before.
Net interest revenue.
Yep.
That's basically the money they make on client deposits, right? The difference between what they earn and what to pay out.
Exactly. It's the spread they earn deploying those client cash balances, like in their bank sweep accounts. And their net interest margin, the NEM, that spread you mentioned, recovered nicely to 2.65%. That's a key metric. Next up, asset management and administration fees. That brought in $1.570 billion, up 14%. This is tied directly to those growing client assets we talked about and the market doing better. Basically, when your investments grow, Schwab gets a piece.
Makes sense.
Then there's trading revenue, $952 million, up 23%, fueled by all that trading activity. And they also have smaller streams like bank deposit account fees and other miscellaneous revenue.
And you mentioned interest rates. How does that whole macroeconomic picture connect to this revenue breakdown?
It connects directly, especially to that big net interest revenue number. The strong recovery there is really significant because it eases those worries about cash sorting from the 2023 bank issues.
Right. Cash sorting, where people move money out of low-yield bank accounts to get better rates elsewhere.
Precisely. People were worried clients would pull cash out of Schwab's sweep accounts. But Schwab benefits when rates are stable or maybe decline gradually. It lets them earn more on those deposits, widen that net interest margin again. So the recent performance suggests those fears are, well, largely behind them. Their model seems well suited to the current rate environment.
Okay, that makes sense.
Yeah.
Now, the financial world is crowded, super competitive. What really sets Schwab apart? What's their moat, their competitive advantage?
The moat. Crucial for any long-term investment. And you're right, it's a battlefield out there. You've got direct competitors like Fidelity, Vanguard, Morgan Stanley with E-Trade, Bank of America with Merrill. Huge players. But then you also have the fintechs, right? Robinhood, SoFi, Interactive Brokers, pushing zero commissions and slick apps, plus the other big banks like Chase getting more into investing.
So how does Schwab defend its turf against all that?
They have several strong defenses. Number one is just sheer scale. We talked about the $10 trillion in assets, millions of accounts. That gives them incredible economies of scale. It means they can operate more cheaply than many smaller players and offer very competitive pricing, sometimes even passing savings to you.
Okay, scale is one. What else?
Their integrated service model, having brokerage, banking, advice, asset management all in one place, that's huge for customer stickiness. It's just easier for clients. A true one-stop shop. And don't underestimate their leadership in the RIA custody platform. Being the go-to custodian for thousands of independent advisors creates this powerful ecosystem. It's a major revenue source and locks in those advisors.
Right, so other advisors depend on them.
Exactly. And finally, their brand and trust. Decades of focusing on the customer have built real loyalty. They consistently score high in satisfaction surveys like that J.D. Power #1 ranking for direct banking. People trust the Schwab name. Plus, they keep investing heavily in their tech platforms to stay user-friendly.
That's a solid set of advantages. Let's talk more about that tech investment. Looking forward, how is technology shaping Schwab's future and, the experience for someone using their platform?
Technology is absolutely pivotal for them. You look at trends like AI and machine learning, ML, the potential there is pretty significant. Think personalized advice through smarter robo-advisors, more efficient back-office operations through automation, better fraud detection, even customer service using chatbots for quick answers.
So making things smoother and potentially smarter for the user.
Yes, though obviously there are costs to implement it, and you have to watch out for potential biases in the AI. But the upside is clear. Then there's just the ongoing digital transformation and mobile-first approach. It's not optional anymore. It's essential. Schwab needs convenient apps and easy digital signups to attract younger, tech-focused clients. And frankly, they're already pretty good at this. Their apps usually get high marks. Data analytics is another big one. They have so much data. Used responsibly, it helps them understand what clients want, develop better products, target marketing effectively, and manage risk better by spotting trends early.
What about things like blockchain? Is that on their radar?
Blockchain and DLT, distributed ledger technology, yeah, they have potential long-term for things like maybe tokenizing assets or making payments more efficient. But for now, Schwab seems more focused on the traditional ways of trading stocks and bonds. Broader use of blockchain in their core business seems further off, partly because the regulations are still evolving. But overall, their consistent proactive investment in tech really positions them well to keep growing and stay ahead of the curve.
Okay, let's pivot back to the investment side. For someone considering buying SEHW stock, what are the key numbers, the ratios that they should be looking at?
Right, the investor metrics. So as of late July 2025, the stock price was hovering around $97.91. That gives it a market cap of about $177.9 billion. Now, valuation. The TTM PE ratio, price to earnings, was 26.32. But the forward PE, looking at expected 2025 earnings, was lower, around 19.26.
And a lower forward PE suggests analysts expect earnings to grow, right? Making the current price look more attractive relative to future profits.
Exactly. A forward PE around 19 for a market leader like Schwab anticipating solid growth is generally seen as pretty attractive in the financial sector. Looking at financial health again, the debt-to-equity ratio was 0.74 TTM. That's considered quite reasonable for a financial firm. And that strong ROE, return on equity we mentioned, 15.91% TTM, just reinforces they're using shareholder money effectively. The TTM earnings yield was 4.21%.
What about dividends? Does Schwab pay one?
Yes, they do. They're considered a dividend growth stock. They just announced a quarterly dividend of 0.27 cents per share. The ex-dividend date is August 8th, 2025, payment on August 22nd. That works out to an expected annual dividend of $1.08 per share, giving a TTM yield of about 1.1%. And importantly, they raised the dividend by 4% last year. That signals confidence in their earnings power and a commitment to returning cash to shareholders.
Okay, dividends are nice, but is there anything else showing their commitment to shareholders? Any other big news on that front?
No, absolutely. This is a big one. In July 2025, Schwab's board greenlit a huge $20 billion share buyback program.
$20 billion. That sounds massive.
It is. It replaces an older $15 billion program and represents something like 11% of their entire market value. It's a really strong signal from management. Basically, they're saying they believe their own stock is undervalued, and buying back shares is a great use of company cash. It's a huge vote of confidence, and it helps boost earnings per share for the remaining shareholders. It definitely got attention. Some banks like TD Cowen raised their price targets after that news.
That is a significant commitment. What about who owns the stock? Does that tell us anything?
Yeah, it does. Institutional ownership is very high, around 72%. That means big players like Vanguard, BlackRock, Dodge & Cox, T. Rowe Price hold large stakes. High institutional confidence like that often suggests stability. And interestingly, the founder, Charles R. Schwab himself, still holds about 6% of the shares. So his interests are definitely aligned with other shareholders, including you.
All right. Sounds like a lot of positives. But every investment has downsides, potential pitfalls. What are the key risks investors really need to keep an eye on with Schwab?
Absolutely crucial to consider the risks. Despite all the strengths, there are definitely things to watch. Number one is probably interest rate volatility. We talked about how important net interest revenue is. So if rates swing unexpectedly up or down too fast, it could squeeze those profit margins. The deposit outflow fears have eased, yes, but that sensitivity is still there.
Okay. Interest rates are key. What else?
Intensified competition. It never lets up. Zero commission brokers, powerful banks expanding their offerings. Schwab has to keep innovating just to stay ahead. They can't afford to get complacent. Market volatility is another factor. If we hit a prolonged bear market, client assets shrink, impacting those management fees. And people tend to trade less in scary markets, hitting trading revenue too.
Makes sense. Any operational risks?
Definitely. Operational and technology risk. Things like cybersecurity threats are a constant concern for any big financial firm. Data breaches, system failures, these are always possibilities. And while the TD Ameritrade integration mostly went well, integrating huge companies always carries some residual operational risk. And finally, regulatory and legal risk. The financial industry is heavily regulated. New rules from the SEC, FINRA, the Fed, they could always increase compliance costs or force changes to how Schwab does business.
That's a pretty thorough list. Is there one risk out of those that you think is maybe top of mind for Schwab's leadership? Or perhaps one that is particularly unique to their specific business?
That's a good question. While they all matter, I'd say that interest rate volatility is probably the most fundamental risk tied directly to their core profit engine. Because such a significant chunk of their income relies on that net interest spread, unpredictable rate moves hit their bottom line faster and maybe harder than some other risks. They can manage operational issues, they can innovate against competitors, but macro interest rate shifts are a bigger beast to handle.
Got it. So putting it all together, the performance, the moat, the risks, what's the general feeling, the market sentiment toward Schwab right now?
Okay.
And how do the broader economic trends feed into this?
Right now, the sentiment seems largely positive. You've got the strong earnings report, that massive buyback announcement, steady client asset growth. Those are all confidence boosters. And crucially, those worries about cash sorting after the 2023 bank stress seem to have really faded as the rate environment stabilized. Things like expanding overnight trading to more securities also help. It shows they're focused on improving the client experience, which the market likes to see.
And the bigger economic picture. How does that look for Schwab?
Generally supportive, actually. First, Interest rates, where they are now, and the idea they might slowly drift down, that's kind of a sweet spot for Schwab's net interest income. Second, economic growth. A decent U.S. economy, like the 2.3% GDP growth in Q2, stable jobs, reasonably confident consumers, that encourages investing, helps client assets grow. You mentioned that Schwab survey finding people feel they need more money that could even spur demand for advice. Third, inflation. It's trending down towards that 2% target. That's generally good because it gives the Fed flexibility on rates, reducing the chance of disruptive sudden hikes. And finally, market volatility. As long as it's not extreme, a bit of market movement can actually boost trading volumes and revenue for Schwab. So overall, the macro trends seem to be blowing more favorably than not for them right now.
Okay, so after this deep dive, let's bring it home for our listeners. What's the bottom line? How should an American investor think about Charles Schwab for their own portfolio today?
Well, summing it up, Charles Schwab really stands out as a solid, robust investment case. You've got this dominant market position, a brand people trust, that comprehensive service model, and financials that look quite healthy. It offers, I think, a compelling mix of stability and potential growth. The recent strong results, especially that earnings beat and, importantly, the $20 billion buyback, are definite positives. Add in those competitive advantages, that moat we discussed, and it looks well positioned. Of course, as an investor, you need to keep watching those key factors. Interest rate movements are top of the list, how client assets are flowing, what the competition is doing. But the core fundamentals look strong, and their shareholder-friendly approach provides a pretty solid foundation, particularly for long-term investors.
So a final thought for you to consider. How critical will Schwab's ability to keep adapting to tech changes, adapting to shifting interest rates, be for them to maintain that dominant position in the years ahead? Something to mull over. Thanks so much for joining us for this deep dive into Charles Schwab. If this deep dive was helpful, please subscribe.